Everyone is excited about AI in finance until they realize what the White House just put into motion. This action plan is about to change how banks, fintechs, and credit unions operate forever. Artificial intelligence and financial services have always been intertwined, but never like today. For decades, banks and lenders used rules-based systems, scoring models, and automated workflows to enhance efficiency. But over the last few years, AI-Satu has undergone a radical transformation, pushing beyond simple predictions and evolving into a dynamic, generalizable technology capable of interpreting language, analyzing behavior, and making complex decisions. In today's content, we dive deep into what this action plan means, why it was created, what it covers, what it leaves unanswered, and how institutions, from banks and credit unions to payments companies and fintech startups, are responding. This is part one of a comprehensive two-part analysis that brings clarity to a complex and often confusing policy landscape. We'll explore foundational concepts, real-world examples, expert insights, and the practical implications of AI adoption in the financial industry. Let's begin with the evolution of AI in finance, because to understand the present, we must first understand how we got here. Financial services are built on data. Every deposit, withdrawal, repayment, purchase, and application generates new information. Historically, institutions used this information through manual processes and early automation systems. But as computational power expanded, so did the ambition of the financial industry. Aki-Satu first appeared in finance through basic machine learning models that predicted default probabilities, detected suspicious transactions, and optimized portfolio strategies. These systems worked well but were limited. They relied on structured data, followed clear rules, and produced essentially mathematical insights. Over the past 5 years, the industry has moved beyond these narrow models to embrace next-generation AI, generative systems, natural language models, deep learning architecture, and multimodal platforms. Now, financial institutions use AI to improve underwriting accuracy, automate credit decisions, power chatbots and digital assistants, scan regulatory documents and monitor compliance, detect fraud before it occurs, analyze transaction patterns at unprecedented scale, personalize customer experiences, model macroeconomic behavior and portfolio risk. The shift from narrow AI into adaptable systems has transformed how institutions operate, but it has also introduced new risks: opaque decision-making, systemic biases, data privacy concerns, unpredictable model behavior, vulnerabilities in third-party systems. This combination of enormous potential and substantial risk set the stage for regulatory action, leading to the White House AI Action Plan. The White House AI Action Plan is not a single law, rule, or regulation. Instead, it's a framework, a blueprint to guide AI development and usage across sectors such as financial services, healthcare, education, security, transportation, and beyond. The plan seeks to balance innovation with responsibility through a series of core objectives. Promote responsible AI innovation. The plan acknowledges the economic importance of AI, but insists on guardrails to prevent harm. Innovation should advance inclusion, improve outcomes, and enhance competition, not reinforce existing inequalities or introduce new risks. Ensure transparency and explainability. Regulators want institutions to be able to explain, in clear human language, how AI systems make decisions. This is especially critical in credit, pricing, eligibility, and risk evaluation. Prevent algorithmic discrimination. If AI automates decisions, like approving a loan or detecting fraud, it must not disproportionately harm any demographic group. Institutions must monitor and mitigate bias throughout the model lifecycle. Strengthen governance expectations. The plan outlines expectations for internal oversight, documentation, validation, and ongoing monitoring of AI systems. It signals that AI-Satu governance will soon be as important as cybersecurity and compliance programs. Improve interagency coordination. Because AI touches many sectors, multiple federal agencies will play a role. The plan pushes for stronger collaboration between consumer protection regulators, banking agencies, technology authorities, and civil rights offices. Aligned with global AI regulations, the U.S. aims to keep pace with frameworks like the EU AI Act. Although not identical, there is a growing global convergence on transparency, accountability, and risk-based regulation. Despite these ambitions, the action plan leaves important questions unanswered, especially about enforcement, definitions, and technical standards. We'll explore that later. First, we look at how this regulatory shift interacts with existing financial laws. Ake Satu in financial services does not operate in a regulatory vacuum. Before the action plan existed, institutions were already subject to a long list of laws governing privacy, fairness, discrimination, data usage, cybersecurity, and automated decision-making. Financial Ake Satu touches almost every regulatory domain. Fair lending requirements. Laws prohibit discrimination in lending based on protected characteristics. Machine learning models, however, can inadvertently produce biased outcomes even when demographic data is excluded. Privacy laws, i.e. models, require enormous datasets, but privacy rules restrict how data is collected, processed, stored, and shared, especially sensitive or identity-linked data. Automated decision-making rules. Several states have introduced laws governing when AI can be used to make or assist in decisions about pricing, eligibility, approvals, or consumer rights. Cybersecurity and data security. Financial institutions must secure sensitive data. Ake Satu increases the number of systems that access or generate data, and therefore increases the attack surface. Vendor management. Banks and credit unions often rely on external Ake Satu vendors. Regulators require strong oversight of these relationships. Model risk governance. Traditional model risk management frameworks were not designed for generative or self-learning AI, but institutions still must comply with them. The White House Action Plan forces institutions to examine how these existing laws intersect with emerging Ake Satu governance expectations. The result is a complex regulatory landscape requiring new workflows, teams, tools, and strategies. As policymakers attempt to regulate AI, experts across law, economics, technology, and academia have raised critical concerns. Their insights highlight the tensions shaping today's Ake Satu policy landscape. Innovation versus regulation. Financial institutions emphasize the need to innovate quickly, especially as challengers like fintechs push boundaries. Regulators, however, are concerned about fairness, privacy, and reliability. The challenge is finding a balance that encourages innovation without sacrificing consumer protection. The problem of defining Ake Satu. Different laws define Ake Satu differently. Some treat any automated decision as Ake Satu, while others restrict the definition to advanced machine learning. This inconsistency makes compliance planning difficult. Explainability and interpretability. Regulators expect institutions to explain how Ake Satu models work, but modern neural networks and large language models are notoriously difficult to interpret. Institutions must develop new tools and frameworks to meet these expectations. Vendor and third-party risks. Most institutions use external AI platforms. These vendors often operate with proprietary technology, limiting transparency into model design. Regulators still hold the financial institution, not the vendor, responsible for fairness, accuracy, and risk management. Competition and market structure. Some experts argue that strict AI rules may favor large players capable of absorbing compliance costs. Others believe regulation will prevent dominant firms from exploiting their data advantages. The balance is still unclear. Consumer trust. Ultimately, public acceptance of AI in finance depends on trust. Consumers want fairness, clarity, and control over their data. Missteps can quickly damage a brand and attract regulatory actions. These expert perspectives help shape how institutions and regulators prepare for the future of Ake Satu. To understand the practical implications of the White House Action Plan, we turn to real examples of how AI is used in financial services today and the risks that arise. Automated credit underwriting. A lender implements a machine learning model that analyzes thousands of variables. It dramatically improves approval accuracy, but retrospective fairness testing reveals biases affecting certain demographic groups. Behavioral fraud detection. A bank uses AI to analyze device behavior, reducing fraud losses. However, certain legitimate customer behaviors are flagged as suspicious at higher rates, potentially creating discriminatory impacts. Generative Ake Satu. Customer service. A credit union deploys an Ake Satu chatbot to answer questions about fees and terms. The chatbot occasionally generates incorrect answers, risking regulatory violations and eroding customer trust. AI-driven regulatory compliance tools. Large institutions use AK-SATU systems to scan evolving regulatory requirements. These tools help compliance teams, but regulators want to know how reliable these interpretations are. Third-party AI models. A regional bank adopts a scoring model from a fintech vendor. Transparency into the model's logic is limited, but regulators still expect the bank to evaluate fairness, accuracy, and security. Each example highlights the interaction between innovation and oversight and why regulators are increasingly concerned. AK-SATU will continue to transform financial services, but its future will be heavily shaped by evolving regulation and market dynamics. The industry is heading towards several major shifts. Greater regulatory alignment. Federal agencies are moving toward unified expectations. We may see joint guidance, standardized definitions, and coordinated enforcement. Institutional AI governance programs. Institutions will need structured frameworks for monitoring AI risk, documenting model behavior, and implementing oversight processes similar to cybersecurity and compliance programs. Fairness and bias testing standards. Expect more defined rules for how institutions must test for discrimination, validate models, and address disparities. Consumer notification and transparency. Consumers may soon receive explicit disclosures when AI is used and may have the right to request human review or challenge automated decisions. Integration of privacy and AI. Data privacy will become inseparable from AI style governance. Institutions must adopt more stringent data controls. Oversight of generative AI. Generative AI brings unique risks. Regulators will focus on accuracy, source data, hallucination prevention, and safety obligations. Shifting competitive dynamics, AK-SATU could widen the gap between large and small institutions, but also enable new fintech partnerships and innovation models. These trends will redefine how financial institutions build, deploy, and manage AK-SATU systems. Although the action plan is ambitious, it leaves substantial gaps that financial institutions must navigate. Lack of enforcement details. The plan outlines high-level principles but does not clarify which agencies will enforce them or how violations will be penalized. Limited technical standards. There is no detailed guidance about which fairness tests, explainability techniques, or risk thresholds institutions must use. Ambiguity on third-party vendors. The plan acknowledges vendor risks but provides little direction on how institutions should evaluate or govern external AI tools. Undefined high-risk AI categories. It is unclear which financial use cases are considered high risk and what obligations those categories impose. Challenges for smaller institutions. Community banks and credit unions may lack the resources to implement complex AI governance programs, but the plan does not address this disparity. Minimal cross-border data guidance. The plan gestures toward international alignment, but does not explain how institutions should manage global data flows. Number clarity on liability. If an AI system makes a harmful or discriminatory decision, who is responsible? The institution, the vendor, or both? These gaps create uncertainty, and uncertainty creates compliance risk. Despite the uncertainty, institutions cannot wait. Proactive steps are essential. Build comprehensive AI governance structures. This includes model inventories, lifecycle documentation, bias testing, drift monitoring, and governance committees. Strengthen data management practices. Institutions must maintain clarity about what data they collect, why they collect it, and how long they store it. Prioritize transparency and consumer communication. Clear explanations of AI-driven decisions reduce regulatory risk and build trust. Invest in explainable AK-SATU tools. Interpretability platforms can help institutions meet regulatory expectations even when models are complex. Enhance vendor oversight. Contracts must define data rights, audit access, fairness expectations, and security controls. Prepare for evolving regulations. Institutions must anticipate future disclosure requirements, fairness standards, and automated decision-making rules. Foster interdepartment collaboration. AK-SATU touches every function: legal, compliance, data science, risk, operations, and leadership. Those institutions that prepare early will be best positioned to innovate responsibly while staying ahead of regulatory shifts.